Good morning, and thanks for having me. It's really a pleasure. I'm glad these are in person again. Honestly, it's been 2 years of over the computer, so it's great to see people face to face. By way of introduction, I'm a senior quantitative researcher at State Street Associates. State Street is a US-based bank. We're the largest custody bank in the world. We also have a global capital markets division for FX trading and repo trading. We also manage money as well from State Street Global Advisors, so we're also an asset manager. My group particularly, State Street Associates, we are a research arm, and we partner with academics from Harvard, MIT, and Boston College to drive our research and apply that research to practical challenges that our institutional clients have to face day to day. So with that, one of the specific areas that we look at is ESG. And to do that, we partnered with George Serafim, who's a highly regarded Harvard professor in this space, to help drive our research. And so I will be pulling information from those studies and those papers that we have done with him and my colleagues at State Street Associates. So just starting off, it's really helpful to understand the landscape of the ESG and how it's impacted institutional investor decision-making and their investment process. So really quickly, just high-level understanding, how has ESG impacted where money is being allocated, capital is being allocated within the market? And it's quite clear just from these charts here. The top left is the forecasted assets under management allocated to ESG-aware funds. And we see that this has grown tremendously, and we're forecasting this to be between 14 to 19 trillion US dollars in the next couple years. Additionally, this bottom chart is showing the buying and selling of ESG funds, and we see that, again, this has grown substantially over the past decade, over the past 10 years. Investors are incorporating ESG into their decision-making, and they're making decisions off of this, institutions and retail investors. We also took a look at this in our own data from State Street. So, like I said, we're a very large custody account, so we have around 44 trillion US dollars that we oversee and account for. And from that information, we can understand what investors are doing, where they're allocating capital, what they're buying and selling. And when we tie in carbon exposure, for example, so understanding how our portfolios exposed to carbon emissions, we see over the last 2 years there has been a drop of around 25% in carbon exposure. And so again, this is reiterating the fact that investors are paying attention to what they're investing in, particularly as ESG becomes more of a prominent factor and starts to materialize in terms of financial performance. So getting into a bit more of what we want to discuss today around supply chain metrics, we wanted to focus in on specifically carbon emissions. This is an area that we've focused on over the past 2 years. And so I will be pulling from a study that we wrote and published in the Journal of Financial Analysts, as well as a few other journals. Just to start, climate change is a really challenging investment, for our institutional clients. There's a long lag between today's impact and how that actually plays out in markets. For example, if we stopped all carbon emissions today, we would still have effects of that in the next decade or two, in terms of perhaps in different geographies. This could be unequally distributed. Some markets might be impacted more than others. And so how do investors account for this? And this is some of the work that we want to kind of get into. On top of all that, we're projected to continue growing our carbon emissions. And so this is, again, adding to that challenge and why it's really important to bring in environmental factors into the investment process. And that leads us to the point around how do we bring in environmental factors into a portfolio to help generate alpha? Is there information in a decarbonizing firm, for example? Is that going to outperform a firm that perhaps has high carbon emissions? And so that's what we start to get into. There's 3 main ways that we can capture carbon emissions of a company that you're thinking about investing in, so an equity. And scope 1, so this is kind of the most straightforward way to capture carbon emission. This is the carbon emissions from a direct operation of that company. So if they're a manufacturing company, what are the carbon emissions from that manufacturing? There's also scope 2, so we can broaden out a bit more and look at how is the carbon emissions of the electricity that they use. Is it renewable or is it based off of more fossil fuels? And so those two added together, scope 1 and scope 2, give us a nice understanding of the total carbon emissions of a company based on their operations. And we could take a further step back and understand, okay, we know their carbon emissions of the operations, but what about their upstream suppliers, the raw materials they gather? How are the carbon emissions from that impacting the firm performance? And then also downstream distribution mechanisms. What are the carbon emissions of those? So when we take all these different measures of carbon emissions, scope 1, 2, and 3, we get a true, what we call the true value of the carbon emissions, a total value chain of those carbon emissions of that firm. So this brings us to the question of what's more important when trying to glean information and generate alpha from an investor's point of view. In our understanding, we have more carbon regulations being put into place. We have carbon pricing that we're thinking about now in terms of the markets in China and Europe specifically. And so from an investor's point of view, there may be some additional information we can get, outperformance of companies that are ahead of the curve there and are decarbonizing, lowering their carbon emissions versus an equal competitor who might be putting out a lot more carbon into the atmosphere. And so when we think about these different measures of carbon, there's drawbacks and there's positives to each one. Operational carbon, it's very objective, it's standard across all different companies, it's easy to measure. The downside to that, it's very narrow in scope. We're only capturing the operational carbon emissions. But when we broaden it out to the total value chain, we find that, okay, so now we're capturing everything, all the carbon emissions of this company. But the drawback is this is really highly estimated and it has to be modeled. There's no clear, transparent reporting into value chain carbon emissions, so it can be very noisy. The third type of measure that investors might want to use in terms of understanding what companies might outperform in terms of environmental risks is an analyst rating, for example, MSCI. This, again, is very holistic, so it captures the full scope of the carbon emissions of a company, and it also integrates other qualitative metrics such as, is the corporate board really paying attention? Do they have a plan in place to help decrease their future carbon emissions? But this is very subjective, and it's not standard. It may differ based on a bias of someone who's writing that analyst score. So this lays out all these different pros and cons. Which ones should be used when we're trying to think of creating a portfolio that has low carbon emissions, but will add returns to our performance? And what we find, and this is from published in our paper, is that there's three main things to consider. And it's all based on the industry that the company is in. So it's actually a mix of those different metrics based on the industry. One of the very important aspects of this is what we call financial materiality. So how important is an environmental metric to that firm's financial performance? If it's in semiconductors, for example, there might be some really high environmental risks for that firm's financial performance. So carbon emissions might be important to that company's future performance. And this is built off of what we call the SASB matrix, which is it's a highly used matrix from investors and also other institutions. And it identifies which ESG metrics are relevant to that industry. So when we're thinking about decarbonizing, we want to know which industry is environmental factors relevant for. And within that, going even a step further, what we find is that when there's a dispersion of climate data, so what we mean by that is within an industry, if firms have really high output of carbon and some have really low carbon emissions, we find that just using operational carbon, so scope 1 and 2 metrics, provide enough information to give us extra returns and generate some alpha. That's not the case in perhaps the software industry, where the carbon emissions are relatively similar across different companies. In those examples, operational carbon, building portfolios off of that isn't helpful. What you actually want to use is the analyst ratings. Analyst ratings incorporate, again, that qualitative side that might be missing in the operational carbon metrics. And additionally, when we're thinking about should we look at the total value chain of the carbon emissions versus operational emissions, we find that within industries where there is a correlation between carbon output of the operations and the carbon output of the total value chain, it's better to use scope 3 in addition to scope 1 and 2. That is to say, when there is when the operational carbon is highly linked to their value chain within that industry, it's better to use the entire carbon emissions, not just the operations. So this is what our clients were very interested in, right? This is understanding, okay, we can't just take one metric and apply it across the board to build a portfolio. What we have to do is be very subjective in understanding, not one metric is going to be useful for every firm in every industry. So in this example here, we start to demonstrate why this is important. And we start to build portfolios, low carbon portfolios, that generate additional alpha for our institutional investors. So what we have here is 4 different portfolios. One is based on just the operational carbon, so scope 1, scope 2. And we find that the performance is not great. It's okay, but it's relatively flat. The same goes for when we look at just the total value chain decarbonization, so selecting, going short these high carbon emitting firms and going long these low carbon firms. We find that, again, we don't get much value from using scope 1, 2, plus 3. And the same goes for analyst ratings. So what this is demonstrating is that if you build a portfolio and select firms just based off of one factor, whether it's your operations, your total value chain, or your analysts, it's not very useful. But what is useful is when we take that rules-based approach I described in the last slide and use those different metrics for each industry based on the information, we get a really nice performing portfolio that is informative and adds alpha to against the Fama-French 5 factors, for example. And this is what we would like to discuss with our clients and bring in terms of how they think about reducing their carbon emissions but increasing the performance of their portfolios. So with that, I'll leave it up to questions.
Travis, thank you. If there isn't any question from the audience, I would like to ask you something.
Sure.
And how are other ESG metrics, social and governance, measured and used by investors?
Yeah, it's a good question, and I think I'm sure it's going to be discussed throughout today, but the materiality aspect is really important. It's understanding for an industry, is it an environmental factor that's important, driving financial performance? Is it perhaps more social? During COVID, for example, we found that when there's a material benefit to that social aspect, that the firms that treated their employees right and had a well-established plan and had positive sentiment outperformed firms that maybe laid off a lot of their employees or had poorly ranking social sentiment. That's just one example of how materiality is important, particularly during drawdowns in the market. And that's usually how we think about integrating them. Yeah.
And ESG metric, how they impact on how investors buy and sell stocks?
It does. And we actually just presented in Vienna last week a study that shows, so in the securities lending market, institutions lend out their securities to earn revenue. And we find that, for example, poorly ranked ESG stocks are highly shorted, and they're also more likely to be engaged on. There's a more likelihood that those firms that own, investors that own those companies that are poorly performing, engage more trying to drive positive performance for those companies and engaging more with the corporate board. Yeah.
And just one last question for an advice to all managers here following ESG Business Conference. So talking about carbon emissions and reporting, how to report to facilitate investors in finding data and metrics?
Yeah, no, I think it's a good question, because I think, as we demonstrated, there is an outperformance of stock prices for these firms that are ahead of the curve in terms of decarbonizing, lower their carbon emissions, and especially within their industry. So relative to their peers within their industry, we find that they are outperforming those that are not. So that's what we're trying to glean the information from here as an investor's point of view. And so I think if you're ahead of the curve, we're seeing that regulations are coming into place from a reporting standpoint and a transparency standpoint, that it'd be more beneficial.
So thank you, Travis.
Thank you
for being with us.